Hello, this is Guan Reinvest. Today I'll be talking about when you should be selling your stock. So when it comes to selling your stock, there are a few different methods you can use. So you can either trim as the position gets higher and higher and higher, or you can just sell the stock when the fundamentals change. So this is what Warren Buffett does, and this is what I would want to do as well in the future when I get a bit more disciplined. So Warren Buffett, he only sells when the fundamentals of the company change or when the management does some stupid defensive acquisitions here and there that will hurt the fundamentals of the company. And there's another super investor as well. His name is Dev Kantesaria. So if you look at his 13F, you look at his activity in the past 2 years or so, he's one of the hedge fund that has minimal activity, meaning to say he only buys in and out maybe once every 4 quarters, basically once every year. And then he only sells his stock when the fundamentals change. And when the fundamentals change, he sells it aggressively. So like for example, let's say he had a stake in Adobe, and as soon as he saw the threat of your AI, your generative AI that could hurt Adobe's market share, he just sold the entire position of Adobe. So that is when you should be selling your positions. But of course, we're all human. We're all human. So what I've been doing is I normally trim my positions as it gets higher and higher. Meaning to say, if it gets maybe 20% overvalued, I will trim my position. If I get 30% overvalued, I'll be trimming my position as well. So for me, I don't think that is the best way to go about it. Meaning to say, that is not what the super investors, the best ones out there, that is not what they do. They have a strict rule book that they follow, and that rule book says that don't sell when the company gets overvalued, because a quality compounder can grow into its valuation. So for example, Dev Kantesaria again, he owns this company called FICO. So FICO is a consumer rating company. They basically rate all your consumer debt and all that. So whenever you buy, like for example, a car, you need to go and get this consumer debt from FICO. And then FICO, they charge the consumer around $7.50 for that rating. So FICO is a monopoly in this field. And for FICO, the valuation has expanded from around a 30 PE in like 2022 to its recent high where it was at 100 PE. And so if you look at Dev Kantasaria's sort of like activity for FICO, right, he only trimmed it when it went above a threshold of like 70 PE, 80 PE and so on. And then he only trimmed his position, meaning to say he still holds about 80% or 90% of his initial FICO position, and he has only been trimming on the way up because he has seen better opportunities to allocate the capital. So to make it short and sweet, you only sell a company when the fundamentals change. And that's what I want to do as well. That's what I want to practice as well. Like for example, Warren Buffett, he only sold Apple when the fundamentals changed. He didn't sell Apple because it was 30 PE. He sold Apple because there's no more growth behind Apple. And that is the fundamental that is switched up. Next topic will be on when to buy a company. Meaning to say, if let's say you already identify a good company, then when exactly should you be buying the stock? So what I do is so let's say I have a company over here, let's say Google. So my current valuation for Google is around $210. So for Google, what I do is I'll go and set buy entries, meaning to say I'll look at support levels. So Google's recent support level was at around 192, so I bought one tranche over there. The next tranche will be around 183, which is the gap support level, and it is around 15% under valuation. And then the next one will be the gap fill, which is 178 or around 175, where it is 20% undervalued. So I usually do a mix of TA as well as some basically to calculate all the different undervalued values. So I'll try and match those up, and then I'll set my buy entries then. And then when the company just hit that price, then I'll just buy already. But again, I don't think that is the right way to do it. So if you look at another super investor, his name is Li Lu. So Li Lu, if you look at his stock portfolio, right, he hasn't been selling our positions, buying our positions very often. If you look at his portfolio, he only has around 8 stocks in total, and Google makes up around 37% of his portfolio. That is crazy concentration. But anyways, so Li Lu is Warren Buffett's understudy, by the way. So Li Lu, what he does is he only buys a company when it gets super undervalued, and he buys like 5-6% at one go, and then he builds the position over 2 or 3 quarters, and that's it already. So this is what I want to do as well, meaning to say I want to buy the companies when it gets super duper undervalued, but I guess it's human nature lah. So for us normal investors, I think the best approach is just to set suitable buy entries down the road and then just buy whenever it hits the buy entry level. This last portion will be on undervalued stocks right now. So if you look at the US market, the US broad markets are all extremely overvalued, but there are still some companies that are extremely undervalued now. So for example, just now I mentioned Google. Google is around 15 to 20% undervalued now. You have United Health as well. It recently just crashed because of the fake DOJ probe case that wasn't even true. So United Health is one of the stocks that I'm looking at as well. I added yesterday, but I'm looking to maybe add more on the way down as well. But I wouldn't make it a very large position in my portfolio because of the risk associated with this company. And there are also some other stocks that I'm looking at as well. So there's MSCI as well. This company is down around 12% from its recent highs, and it's the company that licenses out all your MSCI indices in the entire world. So your MSCI emerging markets, MSCI global index and all that. It is all licensed by this company, and it has a royalty deal with all the ETF issuance. So it has no credit risk, nothing. It is almost a monopoly, not yet, because you have S&P Global as well, another company that is amazing. But these two companies are trading at a very high valuation right now, so I'm staying out of it first. So stocks to buy right now: Google, United Health, maybe some ASML here and there.